Sarah swipes her card at the grocery store. Declined. She tries again. Declined. She calls the bank, and the woman on the phone says something that makes her stomach drop. Her credit limit got cut in half overnight, without warning, without a letter, without anything. 3 weeks later, she applies for an apartment. The landlord runs a check and calls her back with a number. 582. He doesn't even finish the sentence. He just says he's going with someone else. She had no idea her score was that low. She pays her bills. She's never missed a rent payment in her life. So how does a person who thinks they're doing everything right end up locked out of an apartment, denied a car loan, and stuck paying 29% interest on a credit card she didn't even want in the first place? The answer has almost nothing to do with being irresponsible with money. That's the part almost nobody understands. Your credit score isn't really measuring whether you're a good person or a careful person or even a rich person. It's measuring something much narrower, much weirder, and honestly a little unfair. It's measuring whether a computer thinks you look, on paper, like the kind of person who pays lenders back. And that computer doesn't care about your actual life. Here's the first thing that trips people up. The 3 companies that decide this number, Equifax, Experian, and TransUnion, aren't run by the government. They're private companies. They make money by selling your data to banks, landlords, insurance companies, even some employers. Your score is a product. You are the product being sold, packaged into 3 digits between 300 and 850. And each of these 3 companies can, and often does, come up with a slightly different number for the exact same person, because they don't all get the same information at the same time. That already explains part of Sarah's confusion. She checked her score through one app months earlier and it looked fine. But that app was pulling from a different bureau using slightly older data and missing a change that had already happened somewhere else. And it's not just banks and landlords watching that number anymore. Car insurance companies in most states are legally allowed to factor a version of your credit into your premium, on the theory that people with lower scores file more claims. Some employers, particularly in finance and government jobs that involve handling money, pull a modified credit report as part of a background check, even if you're not applying for a single dollar of credit from them. Cell phone providers use it to decide whether you need a deposit before they'll give you a contract. A number originally designed to help banks decide on loans has quietly spread into corners of life that have nothing to do with borrowing money at all. Now let's get into the part that actually explains why her score dropped and why so many people's scores are lower than they think they should be. The single biggest factor, worth about 35% of the whole score, is payment history. Not just whether you missed a payment, whether you were even 1 day late. A payment that's 30 days past due can sit on your report for 7 years. 7 years. One late electric bill that got sent to collections by accident. One hospital bill you didn't know existed because it went to the wrong address, and that mistake follows you nearly a decade. But payment history wasn't Sarah's problem. She'd never been late on anything. So what actually tanked her score? It was the second biggest factor, worth about 30%. Credit utilization. This is the ratio between how much credit you're using and how much you've been given. And this is where the system gets almost sadistic in how it punishes normal behavior. Sarah had one credit card with a $5,000 limit. She used it for everyday spending and paid it off in full every month, which she'd always been told was the responsible thing to do. But the bank doesn't report your balance the day you pay it off. It reports whatever your balance was on your statement closing date. So if she spent $3,000 in a month, even if she paid every cent of it 2 days later, the Bureau saw a 60% utilization rate. Anything over 30% starts working against you. Anything over 50% works against you hard. Then her bank did something that had nothing to do with her at all. They got nervous about the broader economy and quietly slashed credit limits across thousands of customers to reduce their own risk. Sarah's limit dropped from $5,000 to $2,500 overnight. Her spending didn't change. Her habits didn't change. But suddenly that same $3,000 in spending looked like she was using 120% of her available credit. The math flipped against her instantly, and she never got a warning that would let her adjust in time. This is the part almost nobody tells you. Your score can crash through no fault of your own, purely because a bank decided to protect itself. There's a third piece working against people like her too. one that's almost invisible until you understand it. Length of credit history, worth about 15%. The system rewards you simply for having accounts that are old. Not accounts you use well, just accounts that have existed for a long time. Someone who opened their first credit card at 19 and let it sit there, barely touched, often has a stronger score than someone who's financially disciplined but only started building credit 5 years ago. Age beats behavior, at least partially, and that's rarely explained to people starting out. Then there's new credit, worth around 10%. Every time you apply for a loan, a credit card, sometimes even a phone plan, a lender pulls what's called a hard inquiry. Each one dings your score a few points. Do it once, barely noticeable. Do it 4 times in 2 months because you're shopping around for the best car loan rate, and the algorithm doesn't see someone being smart and comparing offers. It sees someone who looks desperate for credit, and it treats you accordingly. And the last 10% is credit mix, which rewards you for juggling different types of debt. A mortgage, a car loan, a credit card. People who've only ever had one type of account, even if they've handled it perfectly, get docked slightly for lacking variety the algorithm wants to see. Nobody ever sat Sarah down and explained any of this. Nobody sits most people down and explains it because the algorithm that calculates it, the one built by a company called FICO back in the late 1980s, has never been made fully public. The exact formula is a trade secret. Banks buy access to the score, not the recipe behind it. So for decades, an entire country has been financially judged by a math equation almost nobody outside one building in California has ever actually seen. Consumer groups have pushed for more transparency for years, and the categories we just walked through are the closest thing to an official answer anyone's gotten, released voluntarily by FICO itself because regulators kept asking. That secrecy is exactly why so much bad advice spreads. Someone tells you to close old credit cards you don't use because it sounds responsible, like tidying up. It's often the opposite of helpful. Close an old card and you lose that account's age, which drags down your average credit history length, and you lose that credit limit too, which can spike your utilization on everything else overnight. Someone else tells you checking your own score hurts it. It doesn't. Checking your own report is a soft inquiry, invisible to lenders and costs you nothing. The confusion isn't accidental. There's an entire industry built on it. Search Fix My Credit Score, and within seconds you'll find companies promising to erase bad marks for a few $100s up front. Most of what they do, you can do yourself for free, mailing dispute letters to the same 3 bureaus anyone can contact directly. A few of them cross into outright fraud, manufacturing fake identification numbers for clients to use instead of their real social security number. A scheme that's landed people in serious legal trouble, not just disappointment. The Consumer Financial Protection Bureau has fined multiple credit repair companies for exactly this. For charging desperate people money to commit a federal crime on their behalf without ever telling them what they were signing up for. Put all of that together and you start to see the actual shape of the problem. It's not that people with low scores are careless. It's that the scoring system rewards a very specific, narrow pattern of behavior: old accounts, low utilization, minimal new applications, a mix of debt types, and punishes almost everything else, including things that look completely reasonable from the outside. Paying off your card in full. Comparing loan offers. Not having much credit history yet because you're young or new to the country. All of it can quietly work against you. So what actually fixes it, and how fast can it move? The fastest lever, by far, is utilization because it's not measuring years of behavior. It's measuring a single snapshot in time. If Sarah pays her balance down before her statement closing date instead of after, the Bureau sees a low number the very next reporting cycle. That alone, within 30 to 60 days, can lift a score by 20, 40, sometimes even 60 points, depending on how extreme the swing was. This is the single most underused trick in personal finance. Most people pay their card off after the statement closes, thinking that's what matters. It isn't. What gets reported is the balance on the day the statement is generated, not the balance after you paid it. The second fast move is asking for a credit limit increase, not to spend more, but to widen the gap between what you're using and what you're allowed to use. A $3,000 balance on a $5,000 limit is bad. That same balance on a $10,000 limit barely registers. Some banks let you request this online in about 90 seconds, and it often triggers only a soft inquiry that doesn't hurt your score at all. Third, and slower but still fast relative to most credit advice. Disputing errors. Nearly 1 in 5 credit reports contains a mistake significant enough to affect the score, according to research from the Federal Trade Commission. A collections account that isn't actually yours. A payment marked late that was actually on time. A closed account still showing as open with a balance. You're legally entitled to dispute these directly with each bureau, and they're required to investigate within 30 days. People who never check their own report for errors are sometimes carrying a lower score for years over a mistake that takes 15 minutes to fix. Fourth, becoming an authorized user on someone else's old, well-managed credit card. You don't even need to use the card. Some of that account's age and payment history can transfer onto your report, which is why parents sometimes add their kids to a decades-old card years before the kid ever needs credit themselves. There's a fifth option too, for people starting closer to zero rather than trying to repair damage. A secured credit card, where you deposit $200 or $300 as collateral and the bank issues you a card with that same limit. It reports to all 3 bureaus exactly like a normal card. Use it for something small and recurring, a streaming subscription, gas once a week, pay it off before the statement closes, and within 6 months most people qualify to graduate into a regular unsecured card with their deposit refunded. It's slow, deliberately boring, and it works precisely because it removes the bank's risk entirely while still building the exact history the algorithm rewards. None of these fix everything instantly, and anyone who promises a jump from 500 to 700 in a week is lying to you. But utilization and error disputes together are the closest thing to a genuine fast track the system has, because unlike payment history, they're not punishing you for the last 7 years. They're reacting to what's true right now. 3 months after that declined card at the grocery store, Sarah had paid her balance down before her statement date for 3 consecutive cycles, disputed a collections account that turned out to belong to someone with a similar name, and asked for a limit increase on the card she'd had the longest. Her score climbed from 582 to 661, not because she became a different person, not because she started making more money. She just stopped feeding a system that was never designed to reward the things she thought it was rewarding, and started feeding the 3 or 4 things it actually cares about. There's one more thing worth sitting with here, something that doesn't get fixed by any dispute letter or limit increase. The people who need a good score the most, someone renting their first apartment, someone escaping debt, someone rebuilding after a divorce or a medical bill that wrecked their savings, are almost always the people the system is hardest on. Thin files get penalized for lacking history. People without extra cash to throw at balances early get penalized for higher utilization. It's not a level playing field, and pretending otherwise doesn't help anyone climb out of it faster. What helps is knowing exactly which levers move first, which ones move slowly, and which ones don't matter nearly as much as the internet tells you they do. 6 months after that phone call about her credit limit, Sarah wasn't thinking about her score much anymore. She'd set a calendar reminder 3 days before every statement closing date, paid down whatever she owed before it, and never thought about it again in between. The number kept climbing quietly in the background, the way most real progress does, without a single dramatic moment attached to it. The apartment she wanted was already gone, but the next one wasn't.